Wondering how to spot a dead cat bounce in trading? Let's break it down in under 2 minutes. Step 1. What is a dead cat bounce? A dead cat bounce is a temporary recovery in a downtrend where the price briefly rises before continuing lower. It's often mistaken for a reversal, but it's just a short-term uptick. Step 2. Look for a sharp, short rally first. Watch for a sharp price increase after a significant drop. This rally is quick and typically lasts a few days, but it's not supported by strong fundamentals or news. Step 3. Low trading volume. Next, check the trading volume. If the bounce happens with low volume, it's a red flag. A real market reversal usually comes with increased volume as buyers step in. Step 4. Technical indicators. Use technical indicators to confirm the bounce. A failure to break resistance or a bearish crossover on the moving averages signals that the rally is weak and likely to fail. Step 5. Be cautious. Always stay cautious during these bounces. If the fundamentals haven't changed and the trend is still downward, don't get tricked into thinking it's a full reversal. That's it. Spotting a dead cat bounce can save you from making a bad trade. Stay sharp and don't forget to subscribe for more trading tips.